Welcome to lecture number 24. In lecture number 23, we did three ratios, namely return on assets, net profit margin, and total asset turnover. Then we did the DuPont analysis involving these three ratios. Now, in lecture number 24, we will do some other ratios. The first one is called operating income margin. The operating income margin includes only operating income in the numerator. Compute the operating income margin as follows. So, how do you calculate the operating income? That is when you have the total revenue or net sales. So, you subtract the operating expenses from it. Now, what are the operating expenses? It is your cost of product sold, cost which is directly related to your products. For example, it could be your, direct material, direct labor, manufacturing overhead, and then you also subtract selling, general, and administrative expenses from it. So when you subtract both of these costs from the net sales, you get the total operating income as it has been calculated in Exhibit 816, 86. Then we look at the operating assets. Now, what is an operating asset? An operating asset is an asset which contributes directly to the revenue generation. So any asset that contribute towards the revenue earned by the company is called an operating asset. So since it has to be a contributory asset, so we definitely, we obviously we subtract construction in progress from it. Why? Because construction in progress does not contribute to any revenue generation at that time. Then we also subtract identifiable intangible assets, net, goodwill, and deferred income taxes and other assets from the total assets to get the operating assets. So once we have calculated the operating income and the operating assets, we can simply calculate the operating income margin by dividing the operating income by the net sales. So this is the operating net income for year 2008 and 2009 for Nike. And you can see that there was a decrease in year 2009. What is operating asset turnover? This ratio measures the ability of operating assets to generate sales dollars. It measures the ability of operating assets to generate sales dollars. I've already told you what an operating asset is. So when we talk about operating asset turnover, we are talking about those assets which contribute directly to the revenue generation, and then we see how efficiently those assets have been utilized to generate sales, and that is called operating asset turnover. The higher the ratio for operating asset turnover, uh, the more efficient the company is while employing and using its operating assets to generate sales. Exhibit 8.8 shows the operating asset turnover for Nike in 8 and 9 and 8. It indicates a moderate decrease from 8 to 9. This moderate decrease is similar to the moderate decrease in total asset turnover. So when we look at the total asset turnover ratio, which we did in 2000 and for 2008 and 2009, we did that in lecture 23. So when we look at it, we'll see that there was a similar decrease as you can see in the operating asset turnover. So we have the net sales. Then since we have to use the average operating assets, so we take asset value at the beginning of the year and at the end of the year, and we calculate average using these two, and then we divide net sales by that figure. So for 2009, we get a figure of 1.74 times per year. And for so we see that the operating asset turnover in 2009 was 1.74 times per year, while in 8 it was 1.84 times per year. So it means that there was a decrease in the operating asset turnover. And you can see that similarly, if you look closely, there was a decrease in operating income margin as well. So as we proceed, I will tell you the relationship between operating income margin and operating asset turnover. So the third ratio is called return on operating assets. Adjusting for non-operating items results in the following formula for return on operating assets. Now, what we are doing when we talk about operating asset turnover, so we take the figure of net sales. And when we talk about return on operating assets, now we are dealing with operating income. You can also call it profit. Exhibit 8-9 shows the return on operating assets for Nike for 9 and 8. It indicates a moderate decrease in the return on operating assets from 8 to 9. The return on operating assets can be viewed in terms of the DuPont analysis that follows. So now we will look at the return on operating assets. We already know that when we talk about return on operating assets ratio, so we always take the operating income or the net profit, and then we divide it by the average operating assets to get the return on operating assets ratio. So you can see there was a decrease in 2009. Exhibit 810 indicates the DuPont return on operating assets for Nike for 9 and 8. This figure supports the conclusion that a minor decrease in operating income margin and a moderate decrease in operating asset turnover resulted in a moderate decrease in return on operating assets. So from this statement, we can see that the return on operating assets gets affected directly by both of your uh, operating income margin and operating asset turnover. So all these three ratios that we have just done are interrelated to each other, and any change in one results in a subsequent change in other ratios. And how do we prove it using the DuPont analysis? The formula is return on operating assets is equal to operating income margin into operating asset turnover. First, we look at the 2008 figures. We see that in 2008, the operating asset turnover was 1.84, which is greater than 2009. In 2008, the operating income margin is 13.07%, which is greater than 2009. So as a result, the return on operating assets that we had in 2008 is higher than what we have in 2009. Hence, we can say that return on operating assets is directly linked to operating income margin and operating asset turnover. If there's an increase in one, so that will also lead to an increase in return on operating assets. If there is decrease in one, it will again lead to reduction in the return on operating assets ratio for that company. Sales to fixed assets. This ratio measures the firm's ability to make productive use of its property, plant, and equipment (PPE) by generating sales dollars. Since construction in progress does not contribute to current sales cannot increase because of any construction in progress that you have. So construction in progress is not a contributing asset towards any company, and or you can also say that it is not also not an operating asset. It should be excluded from the net fixed assets. This ratio may not be meaningful because of old fixed assets or a labor intensive industry. In these cases, the ratio is substantially higher because of the lower fixed asset base. Compute the sales to fixed asset as follows. Now, what is the formula for sales to fixed assets? It is you use the net sales figures in the numerator and you divide it by the average net fixed assets, and you do not include construction in progress in it. So you take the beginning balance for the fixed assets, you take the ending balance from the fixed assets, and make sure you do not include construction in progress in those figures, and then you take an average, and when you divide net sales by that average figure that you have calculated, you get the sales to fixed assets. Exhibit 811 shows the sales to fixed assets for Nike for 9 and 8. It decreased moderately between 8 and 9. Sales increases more than kept up with the net fixed assets increases. Now, how do we calculate the sales to fixed assets? We have the net sales figures for both the years, and net fixed assets we are excluding construction in progress. So we take the beginning balance, we take the end of the year balance, we calculate the average fixed assets for the year, which and this figure does not include your construction in progress. And when we divide your net sales by sales to by your average fixed assets, you get the sales to fixed assets ratio. Now, in year 2009, it is 10.99 times uh, per year. What it means that, for the total number of assets you had, so you were able to generate the sales to fixed assets by the ratio of 10.99. And similarly, in 2008, the ratio was 11.36 times. You were able to generate sales using those uh, average fixed assets that your company have. Return on investment. The return on investment ROI applies to ratios measuring the income earned on the invested capital. These type of measures are widely used to evaluate enterprise performance. Since return on investment is a type of return on capital, this ratio measures the ability of the firm to reward those who provide long-term funds and to attract providers of future funds. Compute the return on investment as follows. Now, what is the significant on return on investment? For example, you are applying for a loan through a bank. Now, a bank is making an investment since it is giving you a loan, and you are supposed to pay interest on it. So for the bank, it will be return on investment. If the bank gives you X amount of money today, how much will it earn on this X amount of money, let's say after 5 years? That is called return on investment. So the formula for return on investment is you have net income before non-controlling interest and non-recurring items, and you add into it, you have to calculate interest expense into 1 minus tax rate. Now, tax rate is the rate at which you have to you pay tax, and then interest expense is how much expense will be related to that investment. And when you divide it by average long-term liabilities and equity, you get the return on investment. This ratio evaluates the earnings performance of the firm without regard to the way the investment is financed. It measures the earnings on investment, indicates how well the firm utilizes its assets base. Exhibit 812 shows the return on investment for Nike for 9 and 8. This ratio decreased materially between 8 and 9. Now we will learn how do we calculate return on investment. Your interest expense is 40.3 million for 2009. Your net income is 1486.7 million. Achha, what is your tax rate? For that, you have to look at the notes as well. Normally, the tax rate is given in the notes which accompany your financial reports. So the tax rate is 24%, and your one minus tax rate obviously will be 76%. Now, when you calculate interest expense into one minus tax rate, so you get 30.63, and your net income plus whatever you have calculated in this part of the formula, this part comes here, net income plus interest expense. So this part, in fact, if you look closely, this part is the numerator of the equation or the formula that you have for return on investment. Now you have to calculate the average of your long-term liabilities and equity. So your long-term liabilities for year 2009 are 1295.9. Then you have stockholders' equity. You have this is for the beginning of the year. Then again you have for the end of the year. You add beginning of the year balances with the ending year balances, and when you divide by two, so you get the average liabilities and equity, average long-term liabilities and equity. So your return on investment will be when you divide this figure, which is C, by the average that you have calculated. So this is called return on investment. What it shows is that if anyone invests in your company, so that investor or maybe that shareholder will get a return of 15.89% on his investment. Now we talk about return on total equity. The return on total equity measures the return to both common and preferred stockholders. Compute the return on total equity as follows. Net income before non-recurring items minus dividends on redeemable preferred stock, you divide it by average total equity. Preferred stock subject to mandatory redemption is termed redeemable preferred stock. This we all did while we were doing the balance sheet. The SEC requires that redeemable preferred stock be categorized separately from other equity securities because the shares must be redeemed in a manner similar to the repayment of debt. That is why we always subtract dividends on redeemable preferred stock from the net income before non-recurring items. Exhibit 813 shows the return on total equity for Nike for 9 and 8. It decreased materially between from 25.36 in 8 to 18 in 2009. So how do you calculate it? It's your net income. From that you have to subtract the redeemable preferred dividends. You get the adjusted income. Once you have the adjusted income, then you get beginning of the year equity, end of the year you calculate average, and then using the formula you get return on total equity. So this is the end of lecture number 24.